Annuities may be a good option, but are usually a far cry from the best option. In this episode, I'm going to answer the question, are annuities a good retirement option? Well, you're going to be blown away with my answer. Get ready. So I'm Doug Andrew, and I've helped people prepare for a comfortable retirement so they will not outlive their money for more than 4.5 decades now. I deem myself a financial strategist, and I also help people minimize unnecessary taxes on their savings and what they're preparing for their future so that they can redirect otherwise payable taxes to causes they support. And so when people ask the question, golly, I've looked at annuities, are they a good option for my retirement to create predictable income? Well, first of all, what is an annuity? An annuity, simply put, is like a savings account with an insurance company. The insurance industry is not only the backbone of America, but the backbone of the world. It's a multi-trillion-dollar industry. It's where governments go to for help when they need money because one of the insurance companies where I put money in max-funded life insurance manages about $3.5 trillion of assets, which is as much as the IRS collects in taxes in an entire year, just one insurance company. So they're huge. So they are deemed pretty doggone safe because historically, in the Great Depression, for example, some real estate dropped 80% in value. Banks closed. 40% never opened their doors again. But legal reserve insurance companies came through with flying colors. Same thing happened in 2008 when 400 banks went under. 900 more were on the brink or the watch list. There wasn't a single legal reserve insurance company that went under in 2008 because they cross-insure each other. It's not like a FDIC, federally insured program. It's actually, in my opinion, far safer. But there's two primary financial vehicles insurance companies offer the general public when we're talking about retirement income vehicles. One is an annuity. The other is max-funded insurance. Annuities are where you save money on a tax-deferred basis. But when you go to access the money, I'm going to share with you next what happens. But that's what an annuity is. I need to share with you that I've never owned an annuity. I probably never will. It is just not the right vehicle for my goals and what I know. So annuities are only tax deferred. If you have an annuity that is inside of an IRA or 401k type of a situation, that means it's been tax deferred anyway. But if you own a non-qualified annuity, it's not an IRA or 401k, you're funding that with after-tax dollars. Whereas a qualified plan annuity, you put in pre-tax dollars. That's going to be taxed when you take it out regardless. But a lot of people will buy non-qualified annuities to create a predictable income stream. And there's all kinds of people, of course, that sell annuities out there, and they're not bad. But why will I never own an annuity? Well, you fund it with after-tax dollars, just like a max-funded insurance contract, my favorite vehicle. You accumulate your money tax-deferred, but that's it. See, a max-funded insurance policy is totally tax-free when you start to turn on the income. When you take money out of an annuity, it is now taxable. And is taxed LIFO. What does that mean? Last in, first out. So let me simplify. Let's say I had $500,000 and should I put it in an annuity? If it's, let's say, earning 10%. Now, a lot of annuities don't earn 10%. There's only a handful that I would ever consider putting my money into, indexed annuities that have certain features that might have a payout as high as 10%. So let's assume you found one that did that. You put in $500,000 at 10%, that's 50 grand a year. As soon as you turn on that $50,000 a year of income, that is taxable. Because in that example, the last money you're earning, your interest on $500,000 is the first money coming out. It's all taxable. You do not get to access any of the money out of that $500,000 tax free, okay, until you dip into that principal, until you start to deplete that, because that was already taxed, so to speak. It's not really tax-free. You've already paid tax on the basis that you put into it. So annuities are taxed LIFO. I prefer to have a vehicle that is either taxed FIFO, first in, first out, so that if I put in $500,000 and I start pulling out $50,000 a year, the first money I put in is the first money out. I'm recovering my basis for 10 years in that example, totally tax-free before I start paying tax. But I prefer a max-funded insurance contract because I can take it out tax-free forever if I do it the smart way. So what is just as safe as an annuity and can actually outperform most annuities? A max-funded indexed universal life insurance policy. Many times with the same insurance company, I can outperform their annuities with a life insurance contract. And people go, wait a minute. Life insurance has costs in it that annuities don't have. But if you ask an annuity specialist, how come with an insurance company that offers indexed annuities, those annuities are capped at 7 or 8%, but with the same insurance companies, the indexed universal life policies are capped at 10 or 12%. How come the caps are higher? That means they will pay you more, and they do not know the answer. Hello. See, sometimes there are hidden costs in annuities that are not there in the insurance policy. So generally speaking, people are flabbergasted when I take the same insurance company and I say, okay, show me an annuity. And by the way, if I owned an annuity, which I doubt I ever will, it would be only maybe 1, 2, or 3 annuities out there, and they're indexed annuities that have special guarantees that if I ran out of money in the annuity, I would not run out of income if I lived to be 120. And so there's only a few annuities that I would ever consider. But in every case, I've been able to outperform that by using a max-funded indexed universal life insurance policy, oftentimes with the same insurance company that offered the annuity. And it confuses people. Golly, I thought insurance has an additional cost, the death benefit. It does, but we're covering the death benefit by maximum funding it, so the amount of insurance at risk is getting smaller and smaller as you get older. And people go, golly, I've never heard of this before. Well, if you've never seen a life insurance policy that gets cheaper as you get older, you haven't seen one structured like I'm talking about. So why would you ever have a vehicle that generates taxable income like an annuity when you could have the same amount of money on deposit with the same insurance company or a similar insurance company and earn a higher payout? Instead of on $1 million getting $60,000 a year, you get $80,000 a year, and it's totally tax-free, whereas $60,000 in the annuity might be taxable. And so you're only going to net $40,000 or $50,000. How much more is $80,000 than $40,000 after tax from an annuity? It is double. Not only that, but the insurance contract will blossom when you die. So at the end of the day, anything left behind in the insurance policy increases in value and transfers income tax-free. An annuity usually does not have a death benefit, or if it does, it's not near as substantial as if you had a max-funded indexed universal life insurance policy. So as we think about are annuities a good retirement option, I would not usually recommend an annuity for the reasons I've shared with you. But here's probably the biggest reason of all. This is a copy of my most recent best-selling book, The Laser Fund. On the front, you'll see these 4 pillars, okay? This one stands for liquidity. This one's for safety, especially safety of principal, more than just safety of the institution. This one is for rates of return, and this pillar stands for tax benefits. So in this book, I talk about a laser rating system. And any place where you can invest money, mutual funds, stocks, a home, real estate, annuities, you can assign a laser score on a scale of 1 to 10. Here's why I would usually not put money into an annuity. Because annuities may not pass the liquidity test very well, because if you put money into an annuity, you usually cannot go access a lump sum without some kind of a penalty. So it doesn't pass the liquidity test with a very high score. As far as safety, yeah, it usually scores pretty high with safety because it's in the legal reserve insurance industry, as I explained. As far as rates of return, they're okay. Most annuities, though, are only going to earn rates of return of 4, 5, or 6%, where max-funded insurance contracts, I can usually earn more like 6 to 10%. But over here, on the tax-favored benefit, max-funded insurance is totally tax-free. Annuities are taxable, and they're taxed LIFO. Therefore, an annuity may only score between 18 to 22 out of a possible 40. The perfect score would be 10, 10, 10, 10. Well, nothing gets a perfect score. But a max-funded indexed universal life insurance policy, which is my favorite vehicle, I call the laser fund, it passes the liquidity safety rate of return test with flying colors, and it's tax-free. It scores like 33 to 35. That is the biggest reason why I would choose a max-funded indexed universal life policy over an annuity, even with the same insurance company. If you want to see how, claim your free copy of that book. Here's how to do it. I would love to gift you a free copy of my most recent best-selling 300-page book, The Laser Fund, which is actually 2 books in one. I'll tell you what, I will pay for the book. You go to laserfund.com, it's on the screen here, and claim your free copy. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will send out a book to you. There's also options there for you to listen and learn and watch and learn. But here's to your brighter future.